Success in trading isn't about predicting markets perfectly or scoring one lucky big win. Long-term success comes from consistency, day after day, trade after trade, decisions compounded over years. And consistency can only exist when there is structure. That structure is a trading plan. Today we're diving deep into something many traders don't take seriously enough: how to build a trading plan that sticks, one that you actually follow, and one capable of supporting sustainable success for years to come. Whether you're brand new to trading or you've been struggling to stay disciplined, what you're about to hear will change the way you operate. A lot of people enter trading thinking that charts, indicators, and market calls are the heart of success. They spend hours searching for the perfect strategy, the magical indicator combination, the secret shortcut someone is hiding. But the reality? Strategies are everywhere. What's rare is a trader who knows how to stick to a strategy long enough for it to work. The reason most traders fail has less to do with strategy and far more to do with discipline, planning, and emotional control. A well-built trading plan is what separates someone guessing from someone operating like a professional. So what is a trading plan really? At its core, it is a written, structured set of rules that guide every trading decision you make. What you trade, when you trade, how much you risk, when you enter and exit, how you handle losses, how you measure performance, and how you improve over time. A trading plan removes uncertainty, removes emotional decision-making, and prevents panic or impulsiveness. It's your framework, your safety net, and your compass. When markets get chaotic, and they absolutely will, you need a fixed set of rules that keep you grounded and consistent. Before we talk about how to build a plan, let's address why most trading plans fail. The biggest mistake traders make is creating a plan that looks good in theory, but doesn't match how they actually think and behave. They build a plan around what they hope they can do, instead of what they realistically can commit to. Maybe they say they'll trade 6 hours a day, even though they work full-time. Maybe they swear they'll risk only 1% per trade, then instantly change it when impatience kicks in. A plan only works if it's honest. You must build a plan around your real lifestyle, your real personality, and your real emotional tendencies. Otherwise, you'll abandon it the first time it becomes inconvenient. Now let's build your trading plan step by step. Start with defining your trading purpose. Ask yourself, why are you trading? What do you want out of it? Are you trading to build retirement growth, to replace your job, to earn supplementary income, to learn and grow steadily? Too many people jump in without clarity. If you don't define your purpose, you will drift with the market instead of steering your own direction. A clear purpose makes every decision easier because you can align your actions with the long-term goal instead of getting caught in short-term emotion. Next comes your trading style. You need to choose the type of trading that fits your personality and your schedule, not what seems most exciting or what someone online claims is best. If you are impatient, scalping might lead to constant overtrading. If you love deep analysis and slower moves, swing trading or position trading might be better. If you have a full-time job, day trading might be unrealistic. The wrong style is a guaranteed path to frustration and inconsistency. The right style allows you to focus, stay calm, and follow your plan. Once you know your style, define exactly what you will trade. This includes the markets you focus on: forex, stocks, crypto, commodities, indexes, along with the specific instruments you will track. A focused trader is a profitable trader. You cannot become an expert in 20 different charts. Pick a small group and master their behavior. Simplicity creates clarity, and clarity creates consistency. Now let's talk about your strategy rules. Your strategy must define exactly what conditions must be present before you enter a trade. Think about it like designing a checklist. What signals confirm direction? What time frames do you analyze? What pattern or indicator validates the move? And just as important, what disqualifies a trade instantly? The more precise your rules are, the less room emotion has to interfere. A trade should never be based on hope, fear, FOMO, or panic. It should be based entirely on predetermined criteria. If the setup is there, you take it. If not, you wait. Next, and this is one of the most critical parts, define your risk management rules. Risk management is the backbone of a trading plan that lasts. You need hard limits, not flexible guidelines. Decide the maximum percentage of your account you will risk per trade. Decide your maximum drawdown before you stop trading and reassess. Decide how many trades you will allow per day or per week to prevent revenge trading or overtrading. Consistent risk management protects you from blowing up. It removes the possibility of one bad decision destroying months of progress. Remember, successful traders are not the best guessers. They are the best losers. They know how to take small losses with no emotional damage. While risk controls how much you can lose, your exit rules determine how you take profit. One of the biggest weaknesses in traders is exiting emotionally. Some exit too early out of fear. Others hold too long out of greed and watch winners turn into losers. Your plan must specify your take-profit targets and your methods for trailing stops or locking in gains. A disciplined exit strategy grows accounts. Hope and fear destroy them. Taking profit should never feel like guessing. It should feel like following a process. Once your rules are defined, you need a section of your plan dedicated to your trading routine. A routine is everything that happens outside live trades. Your preparation, your journaling, your review process, and your intentional improvement cycle. Professionals don't just trade. They prepare, execute, and evaluate. Write down exactly when you review the news or global events, when you analyze charts, when you record results, and when you step away. Without a routine, small mistakes compound silently. With a routine, improvement becomes measurable and consistent. Next, build your journal framework. A trading journal is not optional. It is your most powerful tool for growth and discipline. Record every trade, why you entered, the setup conditions, your emotional state, the result, and what you learned. Over time, patterns will emerge. Patterns that reveal your strengths, your weaknesses, and the behaviors sabotaging you. Journaling takes you from guessing to knowing. If you don't track your progress, you cannot improve it. A trading plan must include how you document your development and how often you review your performance. Another essential component is your psychological rules. Markets move unpredictably, and emotional storms are unavoidable. You need rules for how you behave under stress. What do you do after a losing streak? After a winning streak? How do you prevent revenge trades? What is your rule for stepping away when your emotions take control? Most traders destroy themselves not in strategy, but in emotion. Planning emotional reactions in advance protects you from the worst version of yourself. Finally, your plan needs a process for evolving. A static plan eventually becomes outdated. Markets change. Your skill level changes. Your financial situation changes. Schedule regular review dates, weekly for short-term traders and monthly for longer-term traders, where you evaluate what's working, what's failing, and what needs to be adjusted. Improvement must be intentional. You cannot become consistent without structured iteration. At this point, you might think building a plan is easy, but here's the real challenge: sticking to it. A plan is only as strong as your discipline to follow it. So how do you create a plan you will actually stick to? First, remove unnecessary complexity. Complicated plans collapse under pressure. A strong plan is simple, clear, and executable. Second, internalize the mindset that the goal is long-term success, not short-term excitement. When you accept that your plan is designed to protect you, not restrict you, following it becomes freedom, not limitation. Another way to make your plan stick is to create real accountability. This can be through journaling, through sharing goals with another trader, or through reviewing results publicly or privately. Accountability forces consistency. When you know you must face your decisions, the temptation to break rules decreases dramatically. Also understand the difference between discipline and motivation. Motivation is temporary. Motivation is emotional. Motivation is fueled by excitement. Discipline is doing what needs to be done, regardless of how you feel. You must train yourself to follow the plan, even when everything in you tells you to break it. The more consistent you are, the easier it becomes. Discipline is a muscle. It strengthens with repetition. A trading plan also sticks more effectively when you truly accept that losses are part of the game. When you believe you can and must avoid losing, you will inevitably break rules trying to escape losses. Professionals don't try to eliminate losing. They manage it, control it, and minimize it. Once you stop fearing losses, following your plan becomes natural. Remember, the market owes you nothing. No plan guarantees winning, but a good plan guarantees control. Another essential mindset shift. Results don't define you. Behaviors do. The best traders measure success not by the outcome of a single trade, but by their discipline and execution. If you followed your plan perfectly and still lost, that is a win. If you broke your rules and won, that is a loss disguised as a reward. Reward discipline, not outcomes. If you do that consistently, your plan will become unbreakable. You must also learn to celebrate progress. Growth is slow. Improvement compounds silently. Many traders quit because they expect unrealistic speed. If you improve 1% a week, you transform over time. Celebrate consistent execution. Celebrate controlled risk. Celebrate following rules. Those small wins build confidence. Confidence builds discipline. Discipline builds results. So let's summarize what your trading plan should include. It needs your purpose, your trading style, the markets you trade, your strategy rules, risk management rules, entry and exit rules, routine structure, journaling framework, psychological rules, and your review cycle. And most importantly, it must be written down, not in your head. A plan in your mind is a wish. A plan on paper is a commitment. Take the time today, not someday, to write your plan. Put it in a document. Print it if you must. Read it every day before trading, after trading, and any time stress rises. The more you review it, the more it becomes a part of you. Follow it obsessively. Refine it intentionally. Protect it fiercely. Imagine yourself 1 year from now. Imagine the confidence of knowing exactly what to do, when to do it, and why. Imagine no more panic, no more emotional decisions, no more blowing accounts. Imagine building steady growth, building real skills, building something sustainable. That future is not built by luck or guessing. It's built by discipline, patience, and consistency, anchored by a plan that supports long-term success. Trading is not a lottery ticket. Trading is a craft. It is a profession. Professionals practice, improve, and follow structure. You have everything you need to become that kind of trader right now. Not someday. Right now. The moment you stop reacting to the market and start operating by a plan is the moment you stop gambling and start trading. So take ownership. Build your plan. Honor it. Protect it. Live by it. Because your plan is more than rules. It is the foundation of the trader you are becoming. This is your path to long-term success. Now it's your turn to step up and build a plan that sticks.